guys, it is Ryan.
Neil.
And today we want to talk about the 3 keys to the best rates. We have a lot of people that call in to say, well, what are rates and how do I get the best rates? And what we want to do is just briefly talk about the 3 most important components that will influence your rates and potentially get you the best rates that are available on the marketplace today. The first is obviously your credit score. I always say the credit score is your ticket into the game. That is their initial way of judging you as a borrower to say how creditworthy are you and how much of a risk are you to the bank or to the lender. The higher the score, typically or most commonly, it means that you are very responsible, so the lender feels more inclined to give you either A, more money, or B, better rates. Lower DTI. Neil, what is DTI? Explain.
Debt to income ratio. When you put in all your bills for the month that show you on your credit, like your credit cards, your car payment, everything, and we take your monthly, what you make, your monthly income, and we divide that into plus your new mortgage payment. That's why we always say buy the car afterwards. So your credit cards, if you have your credit cards are, you owe $10,000 on your credit cards and your payment is $500 a month, that's part of your DTI. That $500 plus your mortgage payment, you add that in there, and that's how we get the DTI. You divide that into your monthly income.
Right, so what basically...
Gross monthly income, I'm sorry.
The long and short of it is how much money do you make versus how much money does it show in your credit report that is going out in monthly expenditures. So that's how we calculate what that DTI is. The lower the DTI, the lower the risk you are, the more favorable the lender looks at you and says, we're going to give you a better interest rate. The last component would be the loan to value, otherwise LTV. The lower the LTV, again, the more favorable you look because you actually owe less money on the asset. And that is better for you because, let's just say, for example, if you have a $100,000 mortgage and a typical borrower putting 3 or 3.5%, that's pretty risky. But when you get to 70 or 80%, what does that do?
That lowers their risk. That means you have more skin in the game.
Correct.
You put up 30% and you're only borrowing 70 on 100. Your chances of losing that are a lot less than putting up nothing or 3% down. You can walk away a lot easier as far as the bank is concerned.
Right. So when you're looking to get the best rates, you obviously have to come with your best foot forward. You want to have the highest credit score possible. Now, what does that mean? Maybe keeping your utilization factors lower, making sure that you definitely never miss any payments, and possibly even having some diversification in accounts, having a couple credit cards. Maybe you have a personal loan, a car loan, maybe student loans, or maybe you already have your mortgage. That's what you want to look at as far as diversification. Okay? Lower DTI, obviously, the more you show you save or you're not living thin, the better the lender is going to feel in giving you money, and the lower the LTV.
The more you're putting down.
The more you put down or the more equity you already have into your house, the less risky you look to the bank, so they're going to be more inclined to try to earn your business. So I hope you found that very helpful. If you have any questions...
I did. I understand it now.
Yeah, we understand it better. The more we talk about this stuff, guys, the more we actually understand it. It's better because we talk about things and we may bring light to a subject that we didn't even realize. So if you found this helpful, please share it. Make sure you like it. Give it a thumbs up. If you have any comments or questions, comment below or just send us a message. We'd love to help you and answer your questions. Anything else to add?
Nope, that's it.
You guys have an awesome day.
Thank you.
We'll catch up with you later.